Today we're talking about passive income or dividend investment and why you should have dividend investment as part of your saving plan. So when you buy shares, you buy small parts ownership of a company, and when you own a company, you also have the right to get some of the profits from that said company. And when the company pays out profits to shareholders, you get it in the form of dividend. The dividend is a steady stream of cash that you will get every 3 months from the companies that you own. Some even more frequent than 3 months. Some companies actually pay every month, but let's not get hung up in that right now. So first of all, we'll look at why should you have a dividend portfolio, and that is the snowball effect. Snowball effect is that when the ball starts rolling, as when you make a snowball, it gets bigger and bigger and bigger and bigger. And that is also the case when you come to dividend investment. When you start your dividend portfolio, it's probably not going to be the biggest in the world. Say, we're going to make an example portfolio in the end of this video. You can skip to the timestamp in the description below if you just want to jump straight ahead there as we speak now. But when you start out, you say that you're going to invest a couple bucks, or maybe you have $1,000 to start investing with, and that is not going to give you a lot. It's going to give you a couple bucks in the dividends per month, but it's not going to be a huge deal. It's not going to be a lot at all, and it's going to take a while. But as you keep steady investing in this portfolio, it's going to start showing more results. And by results, I mean you're going to have more and more dividend to reinvest into that portfolio. So what we're doing is you take the starter cash and then you put it into dividend stocks. Those dividend stocks is going to give you dividends. You then take those dividends and you put them back into more dividend stocks by reinvesting the money. And by that, you'll have a wheel that will just keep on rolling, or a snowball for that matter, since that's the explanation we used to begin with. That will just keep getting bigger and bigger. And the more dividends you receive, the more stocks you're going to buy, which is going to result in more dividends. And then you see the plans rolling. So, of course, the point with a dividend portfolio is to make money. So what you might ask in the comments below, as I'm sure someone is going to ask, why not just look for some growth stocks? You can buy Tesla, or you can buy anything else that is going to skyrocket 30% tomorrow and then make your money. That is usually not the case with dividend investment. Dividend investment is a steady and way more safe way. No, that is any safe way to invest in the markets, because markets is always risk involved. Disclaimer below. But it's more of a steady flow. You start small, you will grow step by step as you invest your money, and at the end, hopefully you will reach your goals. So why should you choose dividend investing instead of just doing what everybody else is, which is buying the hot stocks right now? We have seen it. It's been Blue Apron, it's been Tesla, it's been PayPal, it's been Google, it's been all these companies, and you can look at the track record and they have gone up that much. They've been skyrocketing all the way up, and people have made a fortune on it. That's the same story with Bitcoin and Ethereum and whatever not. That everybody has a great track record, that they have skyrocketed, then they have dumped, plummeted, or they have just kept steady flowing. But hitting those unicorns, as they are called, that's very, very unlikely, and you probably should base yourself that you should be a professional investor before you even try to look for them, or at least have a decent amount of time on your hands. But the great thing about dividend investing is that you can follow and buy the companies that you already know. So I could probably sit here all day and make a list of the great dividend companies that I like, and why you should buy them, why you shouldn't buy them, but this is not that kind of video. This is just a basic video jumping into why you should build your dividend investment portfolio and why no amount of cash is too small to start. I know there's a lot of people saying that you should have at least 10,000, 20,000, 50,000, up to 100,000 to start dividend investing. But that's not the case. You can start small, but just expect small returns in the beginning. As we talked about, it's the snowball. Start small, grow bigger. So put whatever money you can now. We're gonna start up with a example portfolio, which you find down in the description, timestamp in the description. So you can jump straight there and have a look. We're gonna start out with a model portfolio of 1,000, which will gonna be my dividend investment portfolio, and I will choose the stocks that I'm gonna start with. We're gonna have a little bit look into that. We're gonna jump into the portfolio in a second, and we will have a look at why I choose these companies, like what I like about them, why I like them, and then we'll take it from there. Alright, so you're still not convinced that dividend investment is for you. You still want that huge growth, but I have a couple more points. Actually, I have 3 more points. First off, if we look at the boring statistics, 90% of the compounded return on the S&P 500 over the last 80 years comes from reinvesting dividends. Which means if you only buy the stocks, you would have lost out almost 90% of the return. But if you had dividend stocks and you reinvest those dividends and expand your portfolio and get the compounding interest, you would have 90% more return. Second off is this is real cash. There's no way that you can bullshit a dividend. The dividend is actually hard cold cash coming into your investment portfolio every quarter. There's no way a company can cheat it. As we have seen in the past, there is a million ways a company can cheat its records. And it happens. We have a couple examples here, and here, and here. Those are 3 recent articles from the newspapers about companies that have either blown up their numbers or just disregarded any law and just reported false numbers to please the investors. But with dividend, that is not the case. Dividend is actual money that has to be paid out. So if the company is bullshitting and has no money, there is no dividend to be paid. They can take up a short-term loan, but they won't be able to keep it up. So what makes me sleep great at night is knowing that all my investments is solid stocks. They pay their dividends. I can see it every quarter taking into my account. I can count them. I can withdraw them. I can reinvest them. Or I can just let them sit there and collect dust if I feel like that. But it is actual cash and it's coming into my account. And the third one is the volatility. Dividend stocks is less volatile in a recession. They pay their dividends, which is a hedge against market losses, and they usually have a very strong balance sheet, which means that even in recessions they will do better than the highly leveraged companies or the ones unicorns that might be super hot on the market right now, but they're not actually making money, or they're making very little money compared to what their cost is. But for now, let's just stop the chit chat and we will jump straight into my actual portfolio. I did buy this portfolio straight before the market crashed, which means that what I spent 1,000 bucks on, you can get for about half if you just buy the same things and we'll look into it. Alright, so as of right now, you should see my recorded portfolio somewhere like here. And we will have a look at it. I'm watching my phone now, guys, so sorry about that. So let's bring up first one, this Brookfield Property Partners. And as you can see, we bring up the year to date, it's half. It's down 51.86%, which means if you buy it now, with the same great expectation that I had a couple of weeks ago, you get it for half the price, which should be motivating for you guys. It's demotivating as awful for me. Next up, we have Occidental Petroleum, which Berkshire Hathaway actually bought a huge share in. This is a controversial company because they have a lot of debt after they bought Anadarko, Anadarko Petroleum. Let's just set it down. It sounds like a spell from Harry Potter, but let's just go with that one for now. Which is down 71% from year to date. And if you're not comfortable in buying a little bit of a high risk company like Occidental, you should look into ExxonMobil, Royal Dutch Shell, British Petroleum. Any of these companies are also great at this price. The oil crash has pushed down the prices. They have high dividend yields of about 7%, I think it is, and they are still performing good. Both Shell and BP has started getting into green energy as well. While Exxon is a little bit behind, they're still a pure oil company, as far as I know. I haven't found any reports for anything else, but they might also come out in the future. They have shown the will to adapt earlier on, so why not in this case as well? So for now, I just have 2 stocks in that portfolio, but you see 4 of them in the portfolio app. This one. Don't get confused about it. I'm talking about this one. You also see PIMCO Dynamic Income Fund, and you see PIMCO Corporate Income Fund. These are ETF trades that is based on bonds. So they are stock market traded, but they're not actual stocks. They're a collection of corporate bonds and mortgage bonds in primarily. They pay a high dividend and they pay monthly income dividends, which is what I'm kind of basing this portfolio of. So I'm gonna have 70% stocks and 30% income bonds with high yielding. So it's high risk bonds, but they are still relatively safe. And they will pay on a monthly basis to keep our cash flow coming into the portfolio so we can buy more stocks. So when we jump into the total portfolio again, we have Brookfield Property Partners, we have Occidental Petroleum, and we have 2 ETFs from PIMCO. We are aiming to increase our dividends steadily per month and then reinvest it into the portfolio. We're not taking it out, we're just reinvesting all along. That is the point of this, to use the dividend to grow the portfolio. Because what we do then is we have parked some cash in stocks that will result in dividends, that will result in payouts, and those payouts can be reinvested again. So for our example portfolio, we are gonna be putting in $100 per month into shares that we find is reasonably priced. We're also gonna diversify the portfolio, and we're gonna fill in this 70-30 gap. Because as you saw now, we have 2 stocks and 2 bonds, and they are about equally weight. We have 50-50 roughly, and we only have 2 sectors in our stock portfolio. So I hope that I wasn't rambling too much in this video. So we will continue to grow our portfolio. I will keep track of the dividends. I will make a spreadsheet down in the description that you can see the dividends income, our holdings and everything else. We might also make a online version later on, maybe. We'll see how this goes actually. But first of all, we'll make a Google sheet and I'll share it with a link below. So if you want to have a start a look at my calculations, my current holdings and all of this, you'll find it down below. As I use a broker that is not really YouTube friendly, Google sheet down in the description. So I think I've talked enough about dividend investing for today. We're gonna cut it down. I'm not sure how this final product is gonna look. Hopefully it's gonna be enjoyable for you guys to watch it. We'll find out. If you did enjoy this video, please do smash that like button, which should be like somewhere down there. And you should also find a tiny red button that says subscribe. I would appreciate it a lot if you pressed it. And I hope that I will see you again soon. But for now, take care.